When you get into financing of real estate, there are different ways that you can do deals, and the more tools that you have in your toolbox and the more fluently you can use them, the better ability you'll have to do deals. And let's figure out 5 ways to do that. Welcome to the podcast, Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach Carson. And this is a show to help you get out of the financial grind by building a profitable and passive rental property business. So if you're interested in that, you're in the right place. Whether you're a brand new listener or a longtime listener, thank you for being back for another episode. The title of this episode is 5 Uncommon Tips to Buy a Rental Property with Little Cash. So if you've been listening to any of my content, my podcasts, my social media lately, you know that I've written a book called The Small and Mighty Real Estate Investor. And a lot of the topics lately have been going deep into the lessons, the tips, the strategies within that book. And today is no different. I want to focus more on the beginner investor, the starter investor, or those of you who are kind of in this phase of just getting into growing your real estate wealth building journey, but you've run out of cash. And either you don't have enough cash because you're just getting started and you're just working hard and expenses are high and you just don't have enough income, or maybe you already bought a couple rental properties, you've already put all your money into those properties, and now here you are. You've got some knowledge, you've got some momentum, you have some team members, relationships, you know how to find deals now, but you just don't have the money. So I want to encourage you and give you a little hope, because if you're in that situation, it can be frustrating and you know you want to continue your growth phase and keep this thing going. And I've been there. I was also there as a new investor. I was also there a few years after I started trying to grow my rental property business. And so I want to share 5 tips that I have actually used. This isn't just theory, something somebody wrote about in a book. I did write about these in the book, and I have a whole chapter on those of you who don't have enough cash to go in even deeper on this topic. So you can check out the book for even more details and examples. But I want to give you some practical ways to apply these today, even in 2023, because something that's really important as a real estate investor is keeping momentum going. You don't have to move super fast. It's okay to buy 1 deal a year, maybe 2 deals a year. And if you're really aggressive, you could buy more than that. But continuing your progress, not having to sit on your hands for the next 2 to 3 years waiting, can actually be really beneficial, because sometimes the market changes, sometimes your energy changes, sometimes life changes. So being able to be creative, and this is what I did early in my career when I didn't have enough capital, I just really focused on buying properties for a 3-4 year period and got really good at it, really focused on it. And I found the capital to do that, even if it wasn't my own capital, and I'll share what those strategies are. And then later on, you might move into a different phase. Maybe you take a break, don't buy as many properties. Maybe you move forward, like I talked about in some of the prior episodes, and start paying off debt on some of your rental properties to try to live off them at some point. So it just depends on where you are in your journey. But I want to focus on those of you who are early in your journey right now, and let's figure out 5 ways to do that. The first tip I want to give you is something you might have heard of, but it's my favorite, it's my go-to, it's always the number one thing I recommend to new investors or people who are tight on cash, and it's called using house hacking. Now, the specific definition of house hacking means you use your residence, the place you live in. You buy a property, you move into that property, and then you rent out part of the property that you live in. So a classic house hack would be a duplex or a triplex, a fourplex. One of my first residences was a fourplex that I moved into unit number 2. I fixed it up. I lived in that unit, and I was able to rent all the other units to pay for all my expenses in that fourplex that I lived in. It was beautiful. I was 24 years old, living for free. So that's a classic house hack, and the benefit of that is that you can get owner-occupant financing. The owner-occupant financing means you can go and get a loan that typically has more advantageous down payments and also interest rates. But from the down payment standpoint, there are programs like FHA, the Federal Housing Administration, that lets you get into a property for 3.5% down. There's other loan programs that are 5% down. And so yes, 3.5%, 5% is something, but compared to if you're buying a $300,000 property and you have to put 20% down, that's $60,000 plus closing costs. Whereas if you have a 5% down, that's a lot less. So owner-occupant financing through the house hacking program is my first recommendation, but I want to encourage you to think a little broadly about what house hacking could be. So you could buy a classic multi-unit property, but in many towns, there aren't as many of those small duplexes. So think outside the box and say, maybe I can move into a house that has what's called an ADU, so an accessory dwelling unit. And this could be different things. This could be a garage that has an apartment above it. It could be a garage that's converted into an apartment. It could be what's called sometimes a granny flat, like a little guest house in the back of the property. And if you just Google this, look, there's so many creative ways to put ADUs in properties. Sometimes they're modular homes that they bring in a crane and they look really beautiful. Sometimes people who are handy build them themselves. But the point is they're often less cost than building a regular big house, and yet they can get a pretty good amount of rent. And you can use that rent to offset the expenses you have of living in that property. Another close relative of house hacking is actually just renting the property you already live in. So if you have a house and you think maybe you're outgrowing your house or you're looking for a new property, you could actually keep the house that you already own, rent that out, and then go buy another house to live in. Now this sounds really, really basic, but many people sell their house instead of keeping it. But if you already have a mortgage that is a long-term mortgage at a good interest rate and you've already put money into this property, as long as it would make a good rental property, that could be a really smart move. And I've seen people build their rental property empires, and I've done this myself by just doing this a couple of times. Do it 2 or 3 times. Maybe you find your dream home in the end and you stay put in that one. But it's a great way to get into rental properties on a limited budget. So all of those are just general house hacking ideas and all have the common theme of owner-occupant financing. But I know not all of you want to live in a property that's going to end up being a rental property, so let me give you some more ideas. Now, the second idea of how you can invest in a rental property with little of your own money is using partners. Now, the idea of partners is that you go buy a rental property, and most investment loan programs, unless you're doing the owner-occupant house hack like we just talked about, is going to require at least 20% down, maybe 25 or 30% as a down payment. Plus, you also have closing costs, plus you might have some repair costs. So the cost and the cash that you have to put into it could get pretty high. Now, eventually, I think you should work on saving your own cash and having your own down payments eventually, but we're focusing on early in your career, and I certainly didn't have that when I first started and when I was growing my rental property portfolio. So the way I thought about it was, if I can find a good deal, a property that's going to make sense over the long run, it's going to get a good cash flow, or it's going to be a good wealth building vehicle, if it's a good enough deal, why wouldn't I just split it with someone else so that I could get a piece of this deal? Now, before I get into the specifics of how that could work, I want to give you a metaphor to think about. Let's say you were going to a store or to a county fair or something, and I happen to like pecan pies. I'm from the southern United States. Pecans and pies, I love it, and if I see one, I want to eat that pie. Well, let's say you found a stand that was selling pecan pies, and they're on sale. They're like typically $20, but they're selling them for $5, and it's just a great deal, but you got to move fast, and you don't even have $5 though. And so you call up your friend or you call up a family member and say, look, I've got a great deal on pecan pies, but it's going to cost $5. If you'll put up the money, I just want a couple pieces, or I want half the pie, I'll give you the other half of the pie. And they know it normally costs $20 as well. And so it's a good deal for you. You get a piece of the pie because otherwise you would have been hungry. And your friend also gets a piece of the pie at a much bigger discount. And that's the equivalent of getting a partner on a really good real estate investment deal. Is you're both benefiting. You're going to bring the deal. You're going to bring perhaps the management of that property, the operations, all the systems of that property. And the person who puts up the money is the money partner. They're going to be more passive in the deal, and it allows them to get into real estate without having to do all the stuff that you're going to do. Now, there are a lot of different ways to structure partnerships. You could have a joint venture where one person owns the property, and then you have an agreement, a contract between the two of you on how you're going to split the profits. You could even set up a company like an LLC, and then you own that property together. That's a little bit more involved. You probably got to get an attorney involved, and you got to go over the operations agreements and paperwork. If you're doing a lot of deals together, that can make sense. I have a full-time business partner. We've been doing business together for 21 years. So I've done that, but I've also done the joint venture agreements. And there's a lot of other creative ways, which I don't have time to get into in this episode, which I talk about more in the book, The Small and Mighty Real Estate Investor. But I want to add something else as another benefit to using partners instead of some of these other tips that I'm going to give you in the rest of this episode, is that when you bring a partner on, and if you're someone who's tight on cash, one of the challenges you're going to have is if whatever cash you do have putting into a deal, rental properties could have some up and some down cash flow. So if you're already in a tight position, bringing on a partner who has a little more liquidity, a little bit more cash, can help you sleep well at night. Because a lot of people get into real estate investing and they leverage everything to the hilt. They use all of their cash. They're on a really tight budget. And if things go wrong, that's when you get into trouble. You can't fix that thing that needs to be fixed. You start missing mortgage payments, and it's not common, but if that kind of thing happens, it could really put you in a tight spot. So I think early in your career, think about my pecan pie example. Say, I'd rather have a piece of a deal and have a partner who can help me in case things go wrong. We could together cover the cost, and you're much more likely to not get in a situation if you have a couple people who can combine your finances to do that. So we've covered house hacking. We've talked about using partners to help you fund your deal. The third tip I want to give you is to use private lenders. So instead of going to a bank where they have a program that says you have to put 20% down or you have to put 25% down, using a private lender is finding an individual, or more creatively, something I've done a lot of, is finding an individual who has a retirement account, like a IRA or a self-directed 401k account, and you can actually help them figure out where to go to set those things up. But the point is, if they have money there, if they have a couple $100,000 in that account, they could loan the money to you, and then you could pay them interest. So instead of splitting the deal like in a partnership, the way a borrower-lender relationship works is you own the property, you have 100% of the upside, 100% of the downside. That's the benefit and the risk to you as the borrower. And then the lender, the benefit to them is they get that set interest rate. Whether that property does well, whether it's vacant and have a negative cash flow, you pay them the interest rate every single month. And then they have a security on that property, either a mortgage or what's called a deed of trust. So if something happened and you stop making mortgage payments to them, just like a bank, they could take the property back in a foreclosure, and then they would be the owner of the property and they'd have to sell it. And one of the benefits of this is in my own career, I've done most of my deals using private money lenders. And I've had a small number of private lenders. It took a little bit to get to know these people. For example, I had a business school teacher when I graduated from college. I went and took a class just for the fun of it to learn more about business. And this business professor over the next year or two became one of my first private money lenders. He was actually one of my private money partners as well. So that last example I gave you, he did some of those deals with me, and we transitioned into being a private money lender. I also met people at local real estate meetups, and the classic private lender for me was a real estate investor, someone who already knew about real estate investing. They already had built some wealth, but they were a little more ambitiously lazy. Like I was out there finding deals and managing properties. They already had some money, and their time was much more valuable, which is natural as you grow as a real estate investor. And so they wanted to be more passive, but they still wanted to be in the game. They still wanted to do deals. And so they would loan me money. Now the catch is, number one, you got to find those people, which is doable, but it's going to take a little bit of work. The other catch is those are pretty savvy investors. They're not going to loan you 100% of a property that's worth $200,000 and they're going to loan you $200,000. Because what happens if you stop paying them? They're going to lose money if they have to foreclose on the property. So it's one of the downsides or challenges of private money is you typically, to get into it for a low money down, you've got to buy that property at a much lower price. So for example, if I find a property that's worth $275,000 and I can buy it for $200,000, I could go to my private lender and there's a good chance they would loan me the $200,000. So most of the money I need, maybe I'd have to pay closing costs out of pocket or something, but they might loan me most of the money I need because there's a gap. There's a lower loan to value. There's equity above that because I found a good deal and I bought it at a lower price. So that's the typical deal if you want to get in low money down that you can do with a private money lender. But there's all sorts of creative ways, and most private money lenders are willing to talk to you, willing to negotiate. If it's a high quality property, maybe they're willing to be a little bit more aggressive. But in general, I like to use a term of about 70% loan to value, maybe even less in some cases. So a $200,000 property, you're going to need to have about $140,000 or less that you're going to be borrowing from a private money lender. But again, a good tool, you want to have a lot of tools in your financing toolbox. And if you don't have a lot of cash yourself, you might say, I've got to go find good deals so that I can get into them with less cash with a private lender or some other source. So the fourth tip I want to share with you to buy a rental property with less money down is to use something called seller financing. Now, in a typical deal, when you buy a rental property, you use a third-party lender. Now, whether that's a bank, whether that's a private lender, whether it's a partner who you're using, someone else is coming up with the money, and then the seller typically gets the money and they go do something else with it. But it's possible, and this is something I've done a number of times in my 20-year career, is to negotiate with the seller, and instead of having to go to a third party to get the money, asking them if you can pay them maybe some money up front and then pay them the rest of the price over time. And this is called an installment sale, is another term for seller financing. And in the classic way that you do seller financing, there's a couple variations that I'll share with you, is that a property owner has a free and clear property, meaning they don't owe any debt on the property, or they maybe have a little bit of debt on the property. And this means they have a lot of equity. So if you're buying a $200,000 property, that means they don't owe any money on it. They have a zero debt, and they can choose to make some money up front. Maybe they could say $10,000 down and then have $190,000 that you still owe them. And it's just like a bank in many ways, that you would have a mortgage or a deed of trust that you would owe to the seller instead of to a third party. And the great thing about this is it's all negotiable. Very similar to a private lender, you can negotiate different payments, different interest rates, different down payments. And in this case, it's possible, although not 100% of the sellers will do it, will allow you to get in for less than a 20% down payment. I'll give you one quick example of a seller who I bought a property from and they chose to finance it to me. I was actually buying a commercial property in my local town of Clemson, South Carolina, and this owner had owned the property for many years, had a business in the property, and was now ready to sell it and was just kind of tired of the management business or just dealing with an investment property anymore. So I made an offer to buy the property for $200,000 with a $20,000 down payment. And then I've been paying him interest plus principal on $180,000 for many, many years now. I talk to him every once in a while. I send a Christmas card. I send him his monthly payment automatically. And we have a good relationship. He's happy that he doesn't have to deal with the property anymore. And I'm happy that I got a property without having to go to the bank. And in this case, I actually got a 3.95% interest rate. I believe was the interest rate we negotiated. So in this case, interest rates today are much higher, and this was a few years back, but I'm still paying that fixed interest payment for a 25-year period. Now, will every seller give you exactly terms like that? No, this is a personal situation. You're gonna have to negotiate. But the thing I like about seller financing as opposed to maybe a private lender is they're often motivated to sell a property. It's not like they're having to go to the bank and take $200,000 out of the bank. No, they have a property that often has a problem with it. Maybe they just don't want to deal with it anymore. Often landlords are your best candidates for these kind of seller financing deals. So if you can offer to take that hassle off their plate, and if you can build some trust with them and show them that you are worthy of their trust to let you make payments to them, and this is not a fast negotiation. You need to let them know why you're creditworthy, show them examples of deals you've done or other professions you have, other credibility that you have. But if you can build that trust with them, then they will be better off in many cases getting the income from the property without having to do all of that work. Now, I mentioned there's a couple of variations on seller financing. One of those is called a lease option. Another one is called buying subject to the mortgage. Both of these are something I've done videos on in the past. I'll have links to some older videos I've done that still are relevant to how those strategies work. But a common theme with both of those is even if there's a mortgage on the property, you might be able to still buy the property with using a form of seller financing. So if you're interested in that, dig into the details. There are some caveats and some things you have to be really careful of using those kind of strategies. But in the right situation with the right property, it could also be a good tool for you to buy it or get into the property with less money down. So a fifth tool or tip that I want to give you to buy a rental property with low money down is to use something called a HELOC. That stands for Home Equity Line of Credit. Now, a home equity line of credit is a special kind of tool that's typically on the home that you live in. And if your property that you live in has grown in value, so you've lived there for a while and you bought it for, $300,000 and now it's worth $500,000, and maybe you put some money down and you've also paid the loan down on that property, it's very possible a lot of people have equity in their existing house. Now, this is a whole nother topic, but equity in your home isn't necessarily a great investment, especially when you're growing a portfolio and you could use that equity to do something else. So you could take what's called dead equity in your home and use a home equity line of credit, where even if you have a first mortgage on the property, you get what's called a second mortgage, and your home equity line of credit is something that you can draw against, where they agree to make you a loan, for example, for $200,000, a bank or another home equity line of credit lender, they would agree to make you a loan for $200,000, and you basically have the equivalent of a checkbook that you can write a check against that loan. So they approve it on one date, and then you can use it at any point until the end of the loan term. And so you could also use that to buy another property. So if you had that $200,000 home equity line of credit, you found a really good deal on a rental property for $200,000, you could write a check and buy that property using the equity in your home. Now, of course, now that you have a loan against your home, there are going to be additional payments on that loan. But the key is you run the numbers so that the rental property that you're buying has more than enough income. Just like you would analyze any other rental property, it needs to have more than enough income. You have enough cash flow to pay all of your expenses on that one property. And then also to have a cash flow above and beyond whatever your interest payment is or your mortgage payment is on the home equity line of credit. Now that's a simple example where you had enough money on your home equity line of credit to pay 100% of the price of the rental property. But you might also come into situations where you combine this tool maybe with another tool. So maybe you get a private lender who's willing to loan you $100,000. Maybe they don't have enough money to loan it 100% of it. So you borrow $100,000 from a private lender and they secure their loan against that rental property that you're buying. And then the balance of it, the rest of the price, plus maybe the closing cost and some other money you have to put into the property, you could use from your own cash and also the home equity line of credit. So it's a very versatile tool, and the benefit is you have 100% control over that. Once you get the loan approved, you can use it to do these things. And the caveat, I would say, there's two caveats. One is you got to be comfortable. You can sleep at night knowing you're borrowing against your home. So very conservative advice would be never borrow against your home. In fact, you should pay that off, because if things go wrong, if that rental property went bad or you couldn't make your mortgage payment on that rental property, then you're risking losing your home. I think as entrepreneurs, we have to take calculated risk, especially early in your career when you're just getting your foot in the door. I've seen so many investors use this as a tool to kind of get them over the hump. So as all entrepreneurs have to do, you have to look at the risk reward ratio and are you comfortable with the risk? That's caveat number one. Caveat number two is know how to use this tool. A home equity line of credit is a short-term tool in my mind. And what I mean by this is the terms of most home equity lines of credit are not 30-year fixed type loans. Often they're 5 years, 10 years, meaning you can use the money for a while. But let's say you had that rental property and it sat there for 5 years, then either you'd have to pay all that money back in 5 years, or maybe it would turn into a longer term loan, but it's like a 15-year loan with really high payments. And so typically they're not the best terms to hold on to a rental property long run. So what you want to do is use that money to buy the rental property and then patiently get it fixed up or get it stabilized and eventually get a long-term loan on that rental property and then pay your home equity line of credit back. It's a great tool to get in and out of a property for rental properties, for maybe fixing and flipping properties, but you want to keep it as a short-term tool and not just leaving it on the property for the long run. So these 5 tools, using house hacking or owner-occupant financing, using private money partners, using private money lenders, seller financing, and home equity line of credit, are all tools that I've either used myself or helped other people to get started and to grow their rental property investing over the last 21 years. And a little bit more about my story. I was 23 years old when I first got into rental property investing, and I had literally $1,000 in the bank. So I didn't have the ability to go and just plop a big down payment on a property. So I had to use these creative strategies. I had to go out and talk to people, get private money lenders, find private money partners, use house hacking. And you can think about this as a toolbox. When you get into financing of real estate, there are different ways that you can do deals. And the more tools that you have in your toolbox and the more fluently you can use them, the more skill you can use them with, the better ability you'll have to do deals. You might have heard this old saying in rental property investing or real estate in general, that if you find a good deal, there's always money available. Well, that could be a little frustrating if you don't know how to get the money, but my goal with this episode was to give you some ideas of how you could do it. If you're out there looking for deals, if you know you can find those good deals or you're confident you could do it, then these are the kind of tools you want to learn. And this episode will give you a start, but if you want to go in more depth, as I mentioned, I have a whole chapter in the book of The Small and Mighty Real Estate Investor, going into more examples of these, showing you how you could use them. And then there's multiple chapters in the book that'll teach you how to run the numbers, how to analyze the deals, how to build a team. And I have a lot of examples of other small, mighty investors and how they did it, how they used it. So this book is like a guidebook for you as a small rental property investor, both to get started, to grow your business, to grow your rental property portfolio, and then eventually when you actually want to retire or just live off of it or have a little bit more peace of mind to get out of the grind and not have to always be beholden to trading your time for dollars, the book will help you transition to that point where you can do things like my family has done. We went to Spain for 12 months and we lived off the rental income. All of those deals that we worked hard to get, sometimes I had none of my own money in, but I scrounged by, figured out how to get a partner. Those same deals have become the source of my income so that I can go do other things. So wherever you are in your journey, I hope that book will be helpful. I'll have a link in the podcast description and the YouTube description. And if you have any questions about these specific techniques or the examples I share, I would love to hear from you in the comments below if you're watching on YouTube, or you can send me an email at podcast@coachcarson.com. I want to wish you best of luck with your own rental property investing, and I hope you join me again next week. I have an amazing interview with some students of mine who have hit that end goal of living off their real estate investments. They have a small and mighty portfolio that's allowed them to move to Portugal, and they're living the expat life. They're enjoying life. And so we talk about their move to Portugal. We talk about how they got started in real estate investing after being in the corporate careers for many years, kind of going through traditional financing and retirement type vehicles, and then transitioning into real estate and using some of their money to buy rental properties. And we get into the details of how that worked, what they're doing now. I think you'll really enjoy that story if you have aspirations of doing something similar. Thanks again for listening, and I'll see you next time.